Hey everyone, and welcome to this explainer. Today, we are looking at a massive structural shift that's pretty much rewiring global energy markets as we know them. I'm talking about the aggressive return to nuclear energy. And standing at the absolute center of this multi-decade supercycle is Cameco Corporation, ticker symbol CCJ. Now, this isn't just another mining stock you can casually trade in and out of. It is a foundational pillar of global baseload power. And really, understanding its mechanics is absolutely crucial for anyone tracking the energy transition.
Okay, let's dive into this. 114.7x. That is Cameco's current trailing price-to-earnings ratio. This instantly tells us we aren't looking at some sleepy, highly regulated utility company. We are looking at a highly unusual, high-stakes situation where the broader market is pricing in absolute explosive future growth. So, here's exactly how we're going to unpack this today. First, we'll establish the macro picture with the nuclear energy supercycle. Second, we'll examine Cameco's specific business model, which is essentially an unbreakable vertical moat. Third, the fortress balance sheet. Fourth, growth catalysts and risks. And finally, number 5, a valuation reality check.
Starting with Section 1, the nuclear energy supercycle, macro drivers and the AI energy demand.
And this brilliantly illustrates exactly why Cameco is thriving right now. To really get it, you have to understand the global energy starvation. The world is desperate for clean, reliable baseload power that intermittent renewables, like wind and solar, just can't provide 24/7. Now, for years, Western utilities relied heavily on cheap, state-sponsored legacy uranium from Russia and Eastern Europe. Well, not anymore. Due to intense geopolitical sanctions and strict national security mandates, there is a frantic, industry-wide pivot toward Western energy security. Buyers are scrambling for non-Russian assets in safe jurisdictions, and Cameco essentially holds the keys.
But it's not just a supply shock, right? Demand is exploding from multiple angles. We've got the widespread electrification of transportation, plus global governments extending the operational lives of their existing nuclear reactors. But the biggest wild card? The massive power requirements of advanced AI data centers. Tech giants are building out these huge server farms, and they're essentially creating an entirely new, highly capitalized customer base for off-grid nuclear power. This perfect storm is driving a steady 3 to 4% expected annual growth in uranium demand straight through 2030.
Which brings us to Section 2, an unbreakable vertical moat, from raw uranium to reactor cores. So the macro demand is clearly there, but how is Cameco uniquely positioned to capture it? Well, a really common mistake investors make is thinking Cameco is just a commodity miner. They aren't. They control an end-to-end supply chain. First, you have their top-tier, low-cost raw extraction. Then they actually control the complex chemical processing needed to refine that ore. And finally, through their Westinghouse joint venture, they fabricate the highly engineered fuel assemblies that actually go into the reactor cores. This deep vertical integration creates incredibly steep switching costs and acts as a structural monopoly in the Western world. That 49% equity stake in Westinghouse, that is the crown jewel. Because once a utility commits to a specific reactor design, they are permanently tethered to the original equipment manufacturer for proprietary replacement parts and multi-billion-dollar lifecycle services. There's no generic alternative you can just grab off a shelf. This gives Cameco incredibly sticky, utility-like, recurring cash flow that's protected by insurmountable barriers to entry. I mean, we're talking decade-long permitting processes and tight proprietary patents.
Section 3. The Fortress Balance Sheet. Financial health and cash flow.
Now, what's really interesting about this is how conservatively they actually run this massive operation behind the scenes. Cameco is sitting on 1.21 billion Canadian dollars in cash and short-term investments, which easily covers their 996 million in total debt. They effectively operate with negative net debt. For a massive industrial mining company, that is incredibly rare. It acts as a total financial fortress, shielding them from the typical bankruptcies and dilution that plague the broader mining cycle when things take a downturn.
And then there's this metric, 1.07 billion Canadian dollars in free cash flow generated over the past year. In plain English, this means Cameco is an absolute cash-generating machine. They are funding their own growth entirely out of pocket while maintaining a highly sustainable, growing dividend, even if the current yield itself is a pretty modest 0.2%. The optionality this kind of cash provides management is just immense.
Think of their massive £230 million contract backlog as a financial shield. It's designed with built-in price floors and inflation escalators. So even if uranium spot prices unexpectedly crater back down to $40 a pound, Cameco is still locking in $55 in 2026. This expertly insulates them from short-term commodity price volatility, all while allowing them to capture the upside as new, higher-priced contracts are negotiated into 2030.
All right, Section 4, Growth Catalysts and Risks, What Drives the Future and What Could Derail It?
Let's look forward at what's actually driving the future of this company. A massive upcoming catalyst for Cameco is HALEU. That stands for High-Assay Low-Enriched Uranium. It's a specialized, denser nuclear fuel that is physically required to operate next-generation small modular reactors. Right now, the West has practically zero commercial capacity for this because they historically relied entirely on Russia. So Cameco and its strategic partners are aggressively positioning themselves to pioneer and completely capture this vital Western supply chain.
But, we've got to balance that incredible upside with the reality of their operations. Their recurring service monopolies provide incredibly safe, consistent margins. The flip side to that, the massive execution risks of building new megaprojects. We are talking about the potential for AP1000 construction delays, multi-billion-dollar cost overruns, and the disastrous financial consequences if even a microscopic defect occurs in a manufactured fuel rod. The stakes in nuclear manufacturing are literally zero tolerance.
So the fundamental business is phenomenal, right? But that brings us to the most critical question for anyone looking to allocate capital. Is Cameco currently priced for perfection? Let's take a breath and pivot from their operational strengths to the harsh reality of their actual stock price.
Section 5. The Valuation Reality Check. Bridging the gap between hype and fair value. Diving into the financial model sourced from the Koala Gains report, I want you to think of the EV to EBITDA multiple as a financial thermometer. A trailing multiple of 71.1x shows the market is running incredibly hot right now. It looks extremely expensive looking backward. However, because older, cheaper contracts are rolling off and new utility contracts at much higher uranium prices are kicking in, expected earnings are set to absolutely surge. That is exactly why the forward EV to EBITDA drops all the way down to 27.9x. The market is fully pricing in this massive growth. So the crucial point is figuring out the exact overlap of these different valuation models, a process called triangulation. Yield and multiples-based methods heavily penalize the stock today because they're only looking at current cash flows during a very capital-intensive transition. But the intrinsic discounted cash flow model actually gives them rightful mathematical credit for their locked-in contract backlog and future pricing power, which pulls the fair value much, much higher.
When we overlay all these models, the triangulated fair value sits between $95 and $130, with a midpoint of $112.50. The verdict? Cameco is fairly valued right now. It is essentially perfectly priced for the incoming nuclear supercycle. And while there's very little margin of safety at these levels, the premium valuation is completely justified by their underlying, flawless business fundamentals.
But we do have to separate the long-term fundamentals from the short-term technicals. Analysis from Stocks to Trade recently highlighted that while the long-term thesis is incredibly strong, featuring that structural uranium deficit, zero net debt, and those massive AI catalysts, the stock is facing some pretty real short-term bearish price realities. There's been noticeable selling pressure and a really tough technical resistance level right around $111. It's a classic tug-of-war between an excellent long-term business and choppy short-term market momentum.
Yet, zoom out at the macro shift is absolutely undeniable. Listen to this directly from Cameco's Q1 2026 earnings report. Across the global energy space, ongoing geopolitical tensions and volatility in fossil fuel supply chains are reinforcing the importance of secure, reliable, and resilient baseload power. Global governments and heavy industries are finally waking up and recognizing nuclear energy's unique and totally irreplaceable position in the modern world.
Which leaves us with the ultimate question. With the global nuclear supercycle fully underway, can Cameco perfectly execute its massive growth pipeline to justify this premium valuation, or will the crushing weight of Wall Street's expectations eventually cause a meltdown? The fundamentals are rock solid for sure, but execution is everything. You'll definitely want to keep a close eye on their next earnings cycle. It is going to be absolutely fascinating to watch unfold. Thanks so much for learning with me today on this explainer, and I'll catch you next time.